Thanks, Ken. Okay, for those of you who were here back in January, a long time ago, when it was cooler, yeah, those were the days, but we started the year off with living to be 100. A number of you said, I do not want to live to be 100. Others of you say, I'm on board. Regardless, we tend to be living longer, and so when we have that topic, we go a variety of ways. This year, when we did Living to 100, we focused on those predictable dilemmas that we're going to face. We live to 88 or 95 or whatever, but there are always these common dilemmas. And they've provided a framework for our seminars this year, housing, healthcare, and so on. This month, we're focusing on that financial aspect. And you'll hear more about that. But that's what kind of the framework that we've been working from. So the way it's worded is David Soley's book that I took these from. His point is, what should I do about money? That's a dilemma we face. From the broad aspect of, am I going to have enough money to live the lifestyle I want? Am I going to be leaving money for my legacy? Are there financial strategies that I need to be aware of to help me along the way? So we brainstormed a lot of those ideas, and we've invited two panelists to be with us today. They're going to introduce themselves in just a minute, but I want to give you a little bit more context. We are going to be, aren't we, Will? Yes, Will, we are, about the financial planning, financial advising, asset management. You're going to have a great resource, Will Boughton, who's one of our educational partners, and he'll tell you more in just a minute. Then we're going to also be talking about a specific strategy that sometimes when we are looking at freeing up some money, that's probably not the right terminology in your world, but it works for many of us. We're going to be talking about reverse mortgages. Now, I am sure that some of you are wincing when I say reverse mortgages, and others of you are gritting your teeth. Do you think that's happening, Lori?
Very true, yes.
So we're going to get the information today. It may not be anything for you, and we certainly understand, but having accurate information is important. And reverse mortgages must be one of the most understood financial strategies around. So you're going to have the facts, and we're looking forward to that. So let's go ahead and tell them who you're with, do your brief introduction. We'll learn more about you. Let's start, Lori, with you.
Hi, I am Lori Anderson. I have lived in Georgetown for 29 years. I kind of have grown up through the banking industry, just like my friend Will here. I worked at First Texas Bank for 8 years and was a lender there. And some of y'all might, if you've been longtime Georgetown residents, it was Georgetown Mortgage. And I started working for them 11 years ago. And I've got 2 grown sons and do all types of mortgages. I don't just specialize in reverse. I do all type of mortgages, construction, whatever. The main reason why I'm so passionate about reverse mortgages is my mother did one 15 years ago before I started working full-time in mortgages, and I was like, what did she do? I'm now very passionate about the education piece of it.
And that's what you're going to be hearing more of. Some of you, you've seen Lori in the community. We appreciate your being here. Yes, she does a variety of mortgages, but today, for the purpose we're about, we're going to be focusing on that. So, Will, tell us a little bit about your background, who you are.
Well, hi, everybody. It's a privilege to be up here in the hot seat, so thank you, Virginia,
He's
for having me.
He's usually back behind the table.
So my name is Will Boughton. I'm a trust officer and a wealth advisor at Vera Bank. I was blessed to move to Georgetown with my family 5 years ago. It's been amazing, and just really glad to be here. So I started my life actually in the wealth management business as really as a broker. Okay, I know I called myself a financial advisor. That was the title we gave ourselves, but I was a stockbroker fundamentally. I kind of quickly figured out I didn't like the brokerage model, so I only did that a few years, and then made the shift over to becoming a fiduciary and really working for banks and helping manage family trusts, and just and helping folks with financial planning and their wealth management life from a fiduciary standpoint, which has made me an awful lot happier. And so I'm glad to be able to tell you a little bit more about that today.
Okay, thanks. And you'll be hearing a lot more about that, including that word we often hear, fiduciary. And it's like, what does it really mean? Does it really mean something? Later
I'll be saying that word a lot.
What's that?
I'll be saying that word a lot today.
Yes, he will. So he's going to educate us about that, too. Okay, so let's go ahead. We're going to start with the reverse mortgage, more of a specific strategy that might be appropriate. But regardless, you need to know about it and about what it really is. So enlighten us, Lori. What is a reverse mortgage? How does it work? Key features and so on.
A reverse mortgage is a loan that is backed by HUD and FHA, federally governed and regulated by that department. The very first documented reverse mortgage was in the 60s, and it was a woman named Nellie, and she lived in a small town. Her husband was a athletic director and a coach. He passed away, and that local community bank made the first reverse mortgage. She did not have enough funds, and they pulled equity out of her house. Fast forward to 1988 and 87. Ronald Reagan signed it into law, and it's part of Section 255 of the Housing Act. Now, a lot of the negative information that we have out there comes and stems from this product and the history of the product. And I can tell you that there's been tons and tons of regulations that Congress and HUD have made to make this product sustainable and go into the future. So it's part of Section 225 of the Housing Act. Its main purpose is to help seniors age in place. It's a tool, it's the only tool that I know out there that is one, non-recourse, and I can explain that in another question. Non-recourse, which means it comes off of your credit. There's no debt to you, your estate, your heirs. The bank does not own your home. The equity is still yours. This is part of Section, like I said, 255 of the Housing Act. Any equity is yours, but it just allows you to stay in the home and not make a monthly payment and use that equity to be able to stay in place. And one of the main fears that seniors have, I'm 57, I'm coming to realize that a lot, is am I going to have enough money to live out my life? And traditional thinking has you have your checking account, your savings account, your money market. And some people in America have pensions and Social Security. My generation and younger, we don't know if they're going to have that, and they've got to save for retirement. And we're taught that our home is out here and it's equity, we don't touch it. It just brings that product in to be able to then manage everything so that you don't outlive your income.
Okay. And it's one of those, it's hard to get a handle on. But as we talk more about it, and then if you need more specific questions or have more specific questions, feel free to visit with Lori. But I do want to emphasize what she said when it first started, and that's when it got a lot of bad press. But as she said, over the years there have been a lot of changes so that it is a reliable, safe product that people can use both for purchasing of a home and for taking their money out.
Let me say this, Virginia. I totally get the negative continuity of this, because when my mom came to me 15 years ago and told me she had done a reverse mortgage, I was like, what did you do, Mother? And I went to the First Texas or Thrive Mortgage at that time and talked to somebody there, and they explained it. Fast forward, then I came to work with them for 11 years, and when you hear information out, a neighbor or somebody moved into assisted living and the bank's taken their house, I challenge you to make sure that you understand all of it. And some of what you hear is just people just not understanding the product. If you think about a conventional loan, an FHA loan, a VA loan, and a USDA loan, is a VA loan safe? Is an FHA loan safe? So is a reverse mortgage. It's no different. It's a loan, but why people do it and how they take it out is different. And a lot of the misconceptions is because things they don't understand or whatever, or they've been changes that they've made to sustain this product, and it's only going to get stronger and stronger. And then the last comment I'll say is there's a financial aspect that financial planners are trying to more and more over the years, there's a financial aspect where you can pull that equity out and have it grow for you in an earnings credit and use it down the road. And I can explain some of that more one-on-one, but it's a very safe product, and it's just used, and like she said, it's not for everybody, but just to understand it and know what it is and be able to do it. If you run across anybody that does that, just tell them, I might know somebody that has information on it. So I challenge you to not be scared of it and just learn.
I think one of the biggest concerns has to do with the repayment. People are concerned if I take that money, or if I'm not making payments, then when I get ready to sell my house, I'm going to have to make a huge payment.
That is also some of the reason why HUD has changed some of the rules. You must be 62 or over. You must make this your primary residence because obviously it's owner occupied. And there are only 3 things that I need to give you the information, and I'm coming up to that, is we get your age, date of birth, the value of the home, and the interest rate. You pop that into FHA's calculator, and it tells us how much equity you can pull out. And so on a cash out in Texas, you can pull 80% of your tax out, your equity out, but in this one, they pull a portion of it out. So then you fast forward to when you're going to move in with your family or you need to downside or something, you still have equity left. You still have equity left, and so it's just a deferred payment. So let's just take, for example, that you need to downsize and you want to go to a smaller home. The first thing you're going to do is go get a real estate agent and ask, what is my house worth? My house is worth $500,000. I owe $200,000 on the reverse mortgage. That equity is use your estates and your heirs, and you just sell the home, and then the loan is paid off.
Okay. In one situation that I know a lot of people might, yes, it wants to age in place, so you're getting money out. It might be that you need to make some modifications on your home to make it easier for you to age in place, and that's been one of the values, I think, of a reverse mortgage. The other one that I see is if you're in the situation where you're in your home and perhaps your spouse is needing more care than you can provide, so perhaps going into an assisted living or a memory care community, can a reverse mortgage help me have some money to cover that expense?
Yes, there are several reasons and motivations for people to do a reverse mortgage. And one of it is to pull out extra cash to be able to take care of someone or pull it out. So let me give a couple of examples. Is you have a house that's worth $500,000. You're able to pull out $200,000 or $250,000, but you have a mortgage that you need to retire. So you retire a small mortgage. That extra cash then can stay in a line of credit, and then as you need it, you can pull it out monthly, a little at a time, to take care of any needs that you have. The other thing is that if you are married, and let's say that your one spouse passes away, your income decreases. And my mother, for example, her income went from $5,600 to $3,500 when she lost her spouse. So any cash or equity that she's got, she can pull that out a little at a time to supplement her income. So it's basically taking the equity that you've got, and what I call it is opening up a wallet. And you don't have to take the money out of the wallet. You can leave it in the wallet, but it's money and access there that you can pull out as you need it for whatever you need it for. Whether it's improvements on the house, whether it's to take care of someone in in an assisted living or any type of scenario. Maybe you need to do it the very first one I ever did, they did not owe anything on their house. They did the reverse mortgage. They let it sit for a number of years, and instead of using long-term care, they used that to have somebody come in and take care, visiting angels to be able to take care, and they pulled out $1,000, $2,000 a month to help them instead of having, a long-term health care. So there's very many reasons, and that's the main thing about a reverse. It's a loan, but the motivation behind it is very different and why you do it, and there's tools there that can help you stretch those dollars.
So you could take the money out and not use it for anything but invest it. Yes, well, it depends on how investments are going and rates and so on. But it could be a source and you could draw from, especially for extra
You can take
care.
the cash out in 4 ways. You can take it out cash at the table, and you can take it out in a term payment. Let's say I need to replace income that I lost because of a spouse. I can get $500 a month until it runs out. It has something called a 10-year payment. It's not 10-year, it's like an annuity, a 10-year. So if I do one, I'm 57, I do one at 62, my husband passes away at 65 and I lose his income, I could say, give me a benefit that'll last my lifetime. And it's guaranteed in Section 255 of the Housing Act. And then the last way is this line of credit, which is generally the most popular. And what you do is you take it out, leave it in the line of credit. If I do not, I will use this example for myself again. 57, I go do one at 62. I'm assuming my house is paid off. I do it, and in 10 years, I have not touched that line of credit. It's got a growth rate that is equal to what is the interest rate on the loan. And it's in Section 255 of the Housing Act. So I will just say that these are books that you can get on Amazon, and you just come see me afterwards. Texas Tech has done studies on these reverse mortgages and how they can be used in financial planning. I am not a financial planner. I do not financially advise. I can only educate you about the product, but there are ways. My only purpose is for you to open your eyes and be able to understand, because we all know somebody that might need something that can help them in a situation.
And in your packet today, Lori did include reverse mortgages, some important facts, and FHA insured reverse mortgage. So that's one of the resources there. Visit with her at the table for more information. We'll probably come back with some more questions. Let me ask you one. So I've taken this money out, and you've said this, but I got to make sure I understand it. So I've taken that money out so I can stay in my home. Now I sell my home. What do I have to give back? What's taken back?
If you take out the reverse mortgage, your home is worth $500,000. You take out the reverse mortgage and you pull out $200,000. And you've pulled it all out and you're done, and you 5 years down the road want to sell and move again. Again, the first thing you're going to do is go get a realtor to tell you what your house is worth. It's now worth $550,000. 5 years down the road, I started with a $200,000 balance. It's now worth $250,000 because I have not been making payments. I sell the house. I take the difference of that, which is leaving me $300,000, whatever my number is. You can take that and then go purchase another house or go use it for whatever you need. The changes that Congress and HUD has made is your home value is going this way, the loan balance is going this way, and you're always generally going to have equity in that house. Let me say one last thing is the deed of trust on a reverse mortgage, all deeds of trust have terms. Mine right now is 30 years. I don't pay that, they're going to kick me out because I didn't pay it. The terms on a reverse mortgage, deed of trust, is the 150th birthday of the youngest borrower. So as long as you pay your property taxes, your homeowner's insurance, you stay in that home as your primary residence. If you leave, you've got to at least live there for a 1 day out of a year. As long as you do all things, you have not done anything to that deed of trust. Nobody can come take your home, and you can stay in that home no matter what you owe or don't owe. That's the non-recourse version. So it's given you some security to be able to make other decisions about what you have to do and what's going on in your life.
So one thing that sometimes there's confusion, oh, I won't have to pay anything. You're not paying towards your mortgage, but you are responsible for your taxes, your HOA, whatever other expenses there are.
Just like you are on your mortgage now.
Yep. So we're going to come back, and I think Lori had a nice segue when she's talking about that this is a tool that our financial planners, advisors can help us with, or see what we have in our portfolio perhaps. But I want to start first with a specific question for Will, because I know that, well, it is related, but the question that people often ask is, what's the difference between between a will and a trust? And related to that is, aren't trusts only for people with a lot of money? So I just want to make sure we get that in there before we talk more about financial planning and management. So,
Thanks. So wills and trusts really fall under the grander umbrella of estate planning. And there's certain things that they have in common and an awful lot of differences. So I'll start on wills. Actually, no, I'll start on the commonalities first, sorry. Both wills and trusts are really a set of instructions that deal with how your assets are distributed following your passing. At their core, that's really what estate planning is. What happens to my stuff when I pass away? And trusts and wills both handle those differently, and there's some fundamental differences in their structure. So wills are probably the more simple of the two, and everybody should have a will. I don't care who you are. If you have anything in this world and anyone you care about, you should definitely, at the very least, have a will. And a will is just that. It is a set of dispositive instructions for your assets at your passing. It's where do I want my stuff to go? And only you get to decide that, nobody else. It's run by an executor, so or personal representative. It will go through what's called a process called probate, in which the person you select as your executor or your personal representative will then file with the court. And to get what's called letters testamentary, gives them the authority to act as your executor. When they receive those letters from the court, they then execute your will. They have a fiduciary duty to do it exactly as you state in your will. Any deviation from that puts them in serious hot water. So it's a very important thing, because there's this other wonderful thing called intestacy, which is when someone doesn't have a will or a trust or any instructions. So not having an estate plan, which we call that, is actually having an estate plan. It's having an estate plan of saying, I want the state to decide who gets my stuff. And that may or may not be in line at all with what you want. So very important to get that done. Once your executor really, goes ahead and distributes all of your assets as you instructed in your will specifically, then they say, okay, the estate is now closed. The estate closes up. It's done. It's over with, and and that's how that goes. A trust, similar to a will, is in a set of instructions that says, okay, this is where I want my stuff to go and who I want it to go to. However, it's an ongoing thing. Instead of just distributing your assets outright, all at one time to whoever's going to get them, you have a lot more flexibility in how that's done in a trust. The trust essentially will be designed to take care of your heirs over a period of time. It could be over generations. It exhausts when it can be exhausted at a certain time for a certain purpose, or it could go on in perpetuity. When your assets go into a trust, the trust then owns the assets. And your trustee, who you have selected, it is their fiduciary duty to follow that trust to the letter, to distribute assets at the times and in the amounts and at the frequency that you decide. And that could be all at once. I've seen that happen. But most of the time, people do that really on an ongoing basis in smaller amounts throughout the beneficiary's lifetime. So the beneficiaries being your heirs. There's a lot of things that a trust can do for you, and it's not just a tool for the rich. I want to say that. A trust could be for anybody that has people in their lives who they want to take care of when they pass away. but they don't want that person to get everything at once, because sometimes that could be doing them an awful lot more harm than good. And I think we all have certain people in our families that can be like that. It just is a matter of people being people. So a trust can actually provide a lot of protection to, let's just say, this is the example, the person in the family who, when they receive money, it just seems to slip right through their fingers and like sand. You have control of the purse strings even when you're no longer around to control the purse strings, because your trustee does, because you left your trustee instructions to do it a certain way. That way, you can set up the standards by which this beneficiary gets money. For example, there's a standard called health, education, maintenance, and support, where at certain times you can give this person certain amounts of money, but they're not going to get all of it at once. And it has to be for a specific purpose, either supporting, their health care, their education, their maintenance. Okay, like for example, if they have rent or a mortgage or anything like that, it'll help with those things. But they can't just come to the trustee and say, hey, I saw this really tricked out truck online the other day and I want to buy it. That ain't going to happen. Not unless you said they can. The trustee can say, I think you're more of a Toyota Corolla person. So that the trustee can make decisions like that for the good of the trust, because sometimes it's not just about that beneficiary. Let's say it's your kids, it's your grandkids. The trustee has a duty to not only take care of, the current generation of beneficiaries, but maybe also the second, even third generation of beneficiaries. So the trustee has that fiduciary duty to. The beneficiary isn't their client, you're their client, whether you're here in the world anymore or not. So a trust can provide an awful lot of flexibility, awful lot of protection for the beneficiaries, just to kind of protect people from themselves sometimes. They can also be used if you're one of those folks who has been, blessed in life enough to be very, very wealthy. They can be used to manage estate taxes. Estate tax is a thing when you get over certain thresholds, and you can utilize trusts to manage to that, to make sure that your estate is not overly exposed to such things. I'm going to spend a little bit of time talking about trustees, because a lot of times people pick somebody in their family to be the trustee. They pick one of their kids, they pick a brother or a cousin or a friend, something like that, which can work. But I've also seen that go sideways in a big way. For example, you've got 3 kids, one of which is just crushing it in life, doing all kinds of great things. They're highly intelligent, they're very responsible. You've got another kid who muddles along and does okay, and then you have another kid who's just kind of like, So you made that I hate to say the brightest, but the brightest kid the trustee. Well, now that kid is now the lord over the assets of the other 2 siblings. Can we say that's maybe a recipe for a little bit of sibling conflict? And I've seen it happen. I have seen siblings suing each other over administration of a trust, even when the trustee is doing the right thing, and it ends up costing the estate money. It ends up putting that poor sibling through the grinder when they're just trying to help their siblings and do what mom and dad wanted them to do. So how do we avoid situations like that? And situations like that are why corporate trustees exist, and that's a huge part of what I do in my business. A corporate trustee is, it has to be a fiduciary for one thing, and the word fiduciary means not only from an ethical standpoint, because I think we all have an ethical standpoint in our lives and whatever we do to be fiduciaries toward others and put other people's interests ahead of our own in all of our dealings. But we also have a regulatory requirement, and we are audited by, for example, I work for a bank, Trust and Wealth Department. We're audited by the OCC, Office of the Comptroller of the Currency, and they come in at least every 18 months and open up all the books of everything we do and make sure that as a trustee for our clients, have we put their interests first? Have we done anything self-serving? We're regulated on that. We have to make sure that that's how we operate. So you don't have to worry about, and this is, I have seen, friends of family trustees, I've seen even attorneys do things in their duties as trustees that just boggles the mind. When you hire a corporate regulated fiduciary, you've got an awful lot of protection on that. And so I recommend them highly. I also recommend executors, corporate executors, for the same exact reasons. And the funny thing is, people say, oh, I don't want to do that. I don't want to pay a trustee. That's expensive. Well, if you already have an asset management relationship with someone who's a fiduciary, you can serve as a trustee, more often than not, it doesn't cost you a penny more than you're already paying them to manage your assets. So talk about cost effective.
Okay, I'm going to kind of redirect just a minute because we're going to come back to that. I want to put in another plug, I guess, for trust from the real estate perspective. When you're selling your home, and if someone has passed away, and it's a will and it's a couple, there always becomes the issue of probate. If the home is, if it's in a trust, it's a lot smoother transition. We don't have to go through probate. We can.
Thank you for that. Yes, because a trust does skip the whole probate process. And it does make things remarkably smoother. An estate doesn't do that. We touched on that earlier, but the trust does completely bypass that as long as the assets are titled in the trust.
Okay, so again, you can talk with Will more specifically, and while I appreciate your describing the examples, and just as Lori did, your business, we always remember they're representatives of the industry. I think they're outstanding representatives, but they're not here just trying to market themselves, but they want you to have information to make your decisions, which I think is so critical. You've already touched on this, Will, but okay, we talk about financial planners. A lot of us over the years have worked, and these words get so confusing, but a financial planner is, as I like you were pointing out to me about, yes, that's when you're working towards accumulating. We're building up this money, and then we reach this point where now we're looking more at management of this, making that money last for us. Lori talked a little bit how reverse mortgages could enter into that. But talk to us a little bit. Will a financial planner, a wealth advisor, are they the same? What's up?
Well, kind of like trust and wills, they're a lot of commonalities, right? They kind of fall under this umbrella of wealth management in general. I guess I'll talk about financial planners, or people who hold out their shingle as a financial planner first. They tend to be a very broad category, actually, and I'm speaking really in terms of business model, especially. And in common, for example, we provide as a trust and wealth management department, we provide investment management, financial planning advice, estate planning advice, all those things. They similarly provide similar advice, especially on the financial planning side, helping accumulate for retirement, managing retirement spending, with those IRA accounts and all those different things like that. But then the term financial planner actually kind of came out of the CFP designation. Who has seen these CFP commercials on TV? A lot. Oh,
now you will, since he's made you aware of it.
Yeah, that's the Certified Financial Planner designation. People who have that designation will call themselves a financial planner, and they have earned the right to do so by getting that education. Financial planners, though, will go to work for a variety of different types of companies. Some may be fiduciaries. There's CFPs in our department, actually. Also, they'll go to work for major brokerage houses. And major brokerage houses, they're not fiduciaries. They aren't generally regulatory held to the fiduciary standard that a regulated fiduciary is. So someone with a CFP designation, financial planner, what they may be compensated on commission. Okay, so they're going to sell you a financial product. They have a duty of suitability, but they're going to sell you a financial product for a commission, right? And this is kind of why I left that business. But so there can be potential conflict of interest, because what is in the best interest of their company, what their company might expect, is to sell you a product that it suits the need and it suits the job, but it might not necessarily be the most cost-effective thing for the customer. And that can be expensive, and honestly, the amount you pay in fees and commissions and taxes and stuff is one of the biggest draggers on your performance long term. So they don't have that same duty to put your interests first, right? There's the potential conflict between making their company happy, feeding their family, and selling you the product that might be the absolute best thing for you. that exists. Some are fiduciaries working for companies like ours. There's also fee-based financial planners that I'm not sure how their regulatory standard works out, but they do offer flat fee schedules and are very non-conflicted. And I think being non-conflicted is really important. Yeah.
So a financial planner, I'm generalizing, which is dangerous, I realize that. But generally, they're looking at managing my portfolio, and their pay that comes often from what's being accomplished with my money.
Right.
Now, a wealth manager, yours is separate from that. You're not making money based on my stocks,
Well,
generally, are you?
Actually, yes.
Oh, okay.
In a far different way, and thank you for bringing that up, because this is an important distinction, and it's easy to get it muddled. So when you're paying someone commission, when you do hire someone to do a job, right, you're hiring someone to do a job, so they are going to get paid for doing said job. The difference in compensation structure is important between someone who works on commission and sells a product and gets a commission for selling that product versus someone who is a fiduciary manager. A fiduciary manager is going to be managing assets on your behalf for a flat fee. Generally, that's going to be a percentage of assets. Okay, it could be, I'd say 1% flat fee based on asset base is low middle market. But because everything is on a flat, it's just, the earth is flat as far as fee schedule is concerned, they don't have a motivation to find a product to sell you that is going to pay them the most, right? What they are then motivated to do is find the best of the best investments that are going to do the job for the client in the most efficient way and cost them the least in terms of actual investment costs. You're paying, it's like if I'm your store manager and you hired me to manage your store for you, my job is to go out and hire employees who are going to do a good job, not overpay them, and control inventory in a way that I'm not costing you a whole ton of money on stuff that's sitting on the shelf and not selling. That's kind of what a fiduciary wealth management structure is designed to accomplish, is, essentially you're paying a manager to do this job. They need to do it efficiently. They need to give you the best of the best within their ability and not cost you undue money, because honestly, the thing that takes the most money out of your pocket as an investor are fees and taxes, not performance.
Will, what would you ask somebody, like give us 2 questions to ask a financial planner to make sure we understand the difference?
I'd say one question: are you a regulated fiduciary? Because they have to answer that honestly. And because you could ask somebody, oh, are you a fiduciary? Oh, I'm a fiduciary, I have a good... regulated to that standard, right? So are you a regulated fiduciary is a really, really good question. And I'd say a number 2 question to follow up with, this is to test, okay, how efficient are you in what you guys do? So what's your management fee? They should be completely transparent with you about that. If someone is a fiduciary and says, oh, well, what do you think my services are worth to you, right? That's not a fiduciary answer. They should come up with a very clear, distinct fee schedule that says, this is what we will be charging to do our job for you, end of story. And then the follow-up question is that, okay, what are the internal costs of the portfolios you manage, right? How efficient is your portfolio? Because investing has expenses, right? You're paying your manager a salary, and his job is to manage expenses. How expensive is that? Because I've seen portfolios that come from folks, and I've done all the analysis and looked at it, and I find out, my goodness gracious, you're paying your manager 1.5% to do his job, and let's say it is a fiduciary platform, but not necessarily truly fiduciary. You're paying him 1.5% to manage your assets, and then I look at the expenses of the portfolio inside, and you've got funds in there. Your average expense inside your portfolio is over 1%. So you're having to overcome like a 3% hurdle every single year to make your first dollar. That's not cool. Those expenses need to be much, much lower than that. And, I would say 0.6% is what I see on average in costs. They should be lower than that even. So fees matter.
So I think some of that is probably included in here. When a lot of us are going, I am getting confused. I got to figure out how to sort through this. In the handouts that Will included in our packet, there's choosing a financial advisor part 1 and part 2, follow the money alphabet soup. So I think that touches on some of what you've talked about, and then also the one about an estate plan.
Correct.
So as we're talking about planning, I'm going to move us on to another related topic. As a realtor and downsizing coach, when often I'm working with people, 2 questions I often hear are, okay, now I'm going to sell my house, and now what am I going to do with my money? And are the best things to do with my money? Who can help people as we talk about, wanting to protect our assets for our quality of life? Are there general suggestions? Who do we turn to?
Well, I'd say first thing when you're dealing with how do I make my money last, well, don't let it sit still. Make it productive. It needs to be invested in something that's making you money, because otherwise you're just spending down whatever principal you have every single month, every single day, right? So yeah, I think number 1, make sure that money is productive and being made productive in an efficient way. I think that's the number 1 key. And then looking at all the pieces available to you. What do we have? How can we plan this, manage this, structure this to where it's going to give us the highest and best use throughout our lifetime, and then you can start thinking about legacy issues, too. But yeah, make the money productive.
So one of the questions that comes to mind then too is that, how long am I going to live? How long do I need this money? I know you're not an actuary, but I think you have some wonderful little programs that help people know how to plan. I assume that's part of a wealth management financial advisor role. Fill us in a little bit about that.
Yeah, so thankfully, there was this thing for years and years and years called the 4% rule, right? If you have a managed, balanced investment portfolio, you can withdraw 4% per year and it'll last you your entire lifetime. Yes and no. That's kind of a hit and miss rule of thumb. So it is better to get maybe a little more granular than that. And there's thankfully in the age of computing, we have a lot of programs at our disposal that can, an advisor like me, you can plug in, get a lot of information from our client about, what are the assets they have, what's the value in their house, how are they structuring that, what's the liquidity that they have access to, right? What is what we call their burn rate, right? How much do we spend per month? Do we expect to go into assisted living at some point? What's that expense look like? Do we expect to downsize our house at some point or sell our house and move into a retirement community? What does that look like? Plug all of those things into this, and then we look at, okay, our risk tolerance, how can we invest according to, what this person can sleep at night doing, because you have to sleep at night too. That's really, really important. And based on all that data, what does it look like over various life cycle expectancies? And you can get pretty darn close, at doing that, and it's really helpful.
When we were talking earlier, you mentioned, and you've talked about it now. Sorry, I wish I had a minute.
I know.
Me and Lori were talking about how much we're suffering with the air quality.
Yeah, well, that was another thing we were talking about, allergies and all. But that whole thing of, am I going to have enough money? I'm moving into independent living or assisted living. It's $5,000, whatever, a month. I'm panicked. And the thing that concerns me the most as I work with people in this area, it's the unknown that causes us the greatest problem. Sometimes we're magnifying problems that really aren't as bad as we think they might be. It comes back to the point of who can advise you for making decisions and planning ahead. And I think that's, yes, professionals are trained in that, and I think I really encourage people to have support in that area. And try to take away some of the unknown, because I think some people, they're not able to enjoy their current life because they're so worried about, yes, we have to be realistic, but sometimes we're a lot better off than we think we are.
That's what they say, knowledge is power. When the more uncertainty you can address, the more peace you have in your day-to-day.
So that's part of encouraging you to have information. And I know many of you are going, I am now completely overwhelmed about this topic. I understand. But take some time to, and you can follow up, visit with Lori and Will at the tables today, or check out information. I asked Will this question earlier too about, I'm still worried about, do I have enough money to even worry about a trust? And we taught, you had given me kind of, and I've heard this from other sources too, a benchmark of $250,000 or so. Explain that.
So, and I'm just going to speak for my institution because that's the point of view that I lived through. We look at, like, for example, if you're hiring an asset manager, right? Someone to do the job of managing assets for you. General rule of thumb for us is when we're looking at a potential new client for asset management, we want to make sure there's around at least a floor of about $250,000 to work with, because that's where someone like me can provide value to the customer, and so it makes sense for them, and it also makes sense from a business standpoint for the bank, because it has to be a two-way street, right? Where value goes both ways, and we find that's kind of where the rubber meets the road on that. For trusts, it can be a little higher than that, maybe up to $500,000 that we look at, but we also look at things below that depending on the customer's need. I know there's a lot of shops out there, especially very big asset management companies that are also fiduciaries, that they won't look at a trust under $5 million. I mean, it's very interesting. We tend to be a lot more open in how we look at it, and we look at customers' need. That's one of the blessings of being a smaller institution. I guess we have a little more flexibility there. But yeah, those are just kind of rules of thumb for us, and it's going to vary from company to company.
Okay, I'm going to, because I have a feeling there are questions from the audience. I hope so. But before I do that, are there any burning things that we haven't addressed? I know we deviated a little bit from our planned questions, but things that you want to make sure you get out there, either one of you, before we open it up.
I guess there's not really any burning questions. I think a lot of what I see and what you touched on it, Virginia, it's fear. It's the unknown. I am 57 and I have lost my stepfather in 2017 and lost my stepmother in last year, and now I've got two separate parents, and the oldest of two sisters, and if something was to happen to both of those sisters, now their kids are old enough, I'm the point person in my family, I guess, and that is a curse and a good thing, and it's scary. To just ask the information. It's not we are very passionate about education and very passionate about making sure that you have the answers and what you need to feel at peace with what you're doing, and that's really, I think, the only thing is just, we're just here for you in any aspect, to just not to push our products, not to do anything, but just to be there to help you and point you and work as a community in Georgetown and be able to share knowledge.
And I think sort of a flip side of that, Lori's talking about from her perspective as the adult child and the concerns that, she's going to be. Now, think about you and your children, your adult children. This is what they're going through too. They're needing to know. Sometimes we don't like to talk about finances with our family, but you know what? It's a lot better to talk about it than not, and to leave it in one big mess where no one, and I'm great at do as we say, not as we do, but I know last summer some situations were going on, and when my son was with me, we spent a lot of time sharing with him more particulars about our portfolio, so we still need to do a much better job, but at least an awareness of it, because it's hard on everybody when our kids don't even know what our investments are or anything about it. And I think back at the very first, one of the first pages in your binder, if I can get it. We encouraged you to be building your team. My peace of mind checklist. Who are your emergency contacts, your caregivers, financial. Do you have your financial information together so that people know where the money is, what the passwords are, who to contact? That's so critical. So that as I'm here, and I'm glad you mentioned that, Lori, and from your perspective, that helps us to think our kids are wondering, oh no, if something happens, I don't even know where to go, what to do. I know when I'm working with people looking at the big picture of downsizing and planning ahead that someday I am going to sell my home and I want to move to perhaps a community, I like to have the kids involved early on so we become a team. So they know mom and dad or whoever have a plan, know who's involved, who to turn to, and it's absolutely critical in the financial aspect, I think.
Used to do a class before COVID that was targeted at my age group, managing decisions with mom and dad, because I think the first time I kind of came to that, I had a little meltdown and was like, I know about banking. I mean, I grew up in banking. I know the deposit side. I know the lending side. But I didn't know anything about what Will talks about. I didn't know anything about, healthcare and all that. And managing decisions with mom and dad. And, of course, with COVID, that's what I'm saying is your kids, your family members, whatever. It's just fear, and we're here.
And, it's always one of those tomorrow. I'll do it next. I'm busy. I'll do it tomorrow. And as we often say, unfortunately, surprises happen, crises occur, and we may not have that benefit of the tomorrow. So the more we can at least have information to share is important. Will, other last comments you want to?
I'm so glad you covered what you covered there. And I'm not going to say anything new, actually. I think I'm just going to piggyback on what y'all have been talking about. For one thing, mañana is not when to do your estate plan. I agree. It is now. It is now. And what you were talking about making sure that there is a trail that helps those left behind to understand where things were for you before you passed away is so important. In my business, we kind of call those breadcrumbs. Your trustee definitely needs a lot of breadcrumbs. Your family needs breadcrumbs. They need to know who your trustee or your executor is. Who are we talking to, right? Make sure that, your executor, your trustee knows where your beneficiaries are. Make sure, yes, we need to know where the assets are, because their first duty, your trustee or your executor, is to gather and bring the assets, inventory all the assets and bring them under control, because they've got to do it. And if they don't know where stuff is, it can be bad for everybody. So yes, that is so important.
We've touched on that in a variety of ways in the seminars. We did the one end-of-life planning, graceful exit, and other topics. We keep coming back to the importance of that. So hopefully, and I feel sure as we start planning for 2024 seminars, I think one of the ones we'll be doing early on, more specific about wills, probate, trust, and all that. We've done them before, but there are lots of topics, and we rotate through, and that'll be one I think will be a high priority for 2024. I want to open it up for questions that you have. And again, I know that some of you may have more specific questions that we can't deal with your individual situation, but if there are questions that can be kind of general that are you're pondering or that your neighbor is pondering. I'm not worried about this, but my neighbor is worried about. Neighbors are great to, be the cover for us. So any questions that you can think of? Oh, okay, we'll come back to you in just a minute, Cora.
Four, five, six.
There we go. Yay.
I'm interested in the state of Texas. If someone has a will and a trust that was written in another state, are there things in Texas that can't be included in a trust?
So if you didn't hear it, the question was, if you have a will or trust that was done in another state and now you're using it in Texas, are there things we need to be aware of? How valid will it be? Are there things specifics to state that may need some kind of variation? Is that right, Bud? Kid. Okay. And again, we know Will's not an attorney, but you do deal with this in terms of estate planning, so.
Thank you for that segue. Yes, I am not an attorney, so anything that I say, please do not take as legal advice. I'm also not a CPA, so don't take it as tax advice either. But yeah, to address your question, that's a wonderful question, and thank you for asking it. So, you know, really the state law governing the trust that it was created, when the trust is created in, is going to govern the trust. So a Texas trustee, just using trust for example, can manage a trust from another state. We just need to make sure that your trustee is going to be aware that, okay, this is managed, this is, say, state of Missouri, for sake of argument. We need to make sure that, okay, I'm going to have to get familiar with Missouri estate law, and I'm going to make sure I have to administer it according to that. A Texas trustee could do that, right? Then you have, let's say you have a Texas trust, and it's got agriculture property, maybe oil and gas interests, all kinds of things in all kinds of places all over the country. Okay. That can be pretty easily managed. We do it all the time as a matter of course, especially when we look at oil and gas properties, working interests, things like that. Those tend to be all over the country. And that is one of the values that I think a professional trustee can bring to the table, is having the knowledge base to deal with that stuff. It's important. So yes, it can be done. I hope that answered that sufficiently.
And the related question is often, you know, we did our will years ago. Do we need to update it? Generally, it would be a good idea, as you know, families change over a period of time. Grandkids grow up, and you know, so you need to make sure that your will, or try both, updated, right?
The rule of thumb, every 5 years, sit down with your estate planning attorney. I think having an accredited estate planning attorney is extremely important. They're the ones that create these things. Sitting down with them every 5 years and reviewing it and saying, is this still appropriate to my wishes? Can't be overstated.
And I know I don't need that, we can do it ourselves. Oh, I think we just had the buzzer sound. Not a good idea. I know we've got ultimate do-it-yourselfers, and I'm all for that. I'm all for saving as much money as you can, but often it costs us in the long run in a variety of ways. So that's the reason we have professionals. And I mean, I think these are great. Doesn't mean, but you know, get professional advice. Cora, you had a question.
Yes. In a reverse mortgage, can a couple do a reverse mortgage? One is staying in the home and the other one just needed like memory care, and they needed money out of the mortgage. One is going to stay in the house, the primary resident, but one, the money is for assisted living or memory care.
Absolutely, absolutely. As long as your deed of trust will say, as long as the last living spouse or whoever's remaining departs the home. So yes, absolutely.
And I just see over and over that can be a very beneficial strategy, and I think people are often not aware of that, or they read into it more limitations than there may be. So just word of advice, go get accurate information. Thanks, Cora. Other questions people have? Yes?
Can an irrevocable trust be closed, and what are the steps for that?
Excellent question.
Okay, the question was, can irrevocable trusts be closed, and what are the steps in doing that? Because when we look at trust, we see revocable and irrevocable, and I think we have to be very careful here. None of us are attorneys. We deal with them in a variety of ways, but if you want to take a shot at it with all the disclaimers that you're not an attorney, go for it, Will.
So yes, disclaimer, I am not an attorney, and anything I say should not be construed as legal advice. Okay, that's out of the way. That was a wonderful question, because there really are two different types of main types of trusts, irrevocable and revocable. Irrevocable is a living trust, and so long as you are living, you are generally going to be the trustee of your own trust, and you can decide, I want to just do away with this thing and do something completely different. You can do that at any time while you're living. At the time you pass away, it then becomes irrevocable, and you know, so that it can't just be, you know, revoked or changed. There are also trusts that are initially created as irrevocable trusts, and people do that for various reasons. So once a trust is irrevocable, or if it was created irrevocable, kind of immaterial at this point because it's irrevocable. That's not entirely true, because The trustee, because built into the language of that trust, your attorney is going to talk about, okay, what is the termination provisions within this trust? There will be those. Usually, it can be that when the trustee says this trust has gotten to the point where, we say the corpus, right, meaning the assets in the trust have come down to a point over time that it's no longer economical for us to manage it, and it's also not serving the beneficiaries by existing. Right, so at that point, that can be really legal point of termination for that trust. State law is going to dictate that. Sometimes the trustee can just essentially declare, sign affidavits, it's closed, they close the account, it goes away. In other states, you kind of have to petition the court to say, hey, we want to make sure this goes down. In Texas, it kind of goes both ways. So it'll be highly dependent on state statute how that happens, but certainly any trust can go away when it exhausts. Also, if it's a trust created for minors, let's say, for example, there might be a provision, this trust will terminate when they turn age 25 or at some certain event. That can also be grounds for terminating a trust. There's a lot of flexibility within that. It doesn't have to just go on forever for the sake of existing. Hope that helps.
Another resource that kind of touches on that, for those of you who were here back in February, or if you weren't, it's on our website. Our topic in February this year was getting your affairs in order. And then we had Debbie Pearson, who was one really looking at long-term planning and caregiving and care for amazing resource, and she has a book that's a great resource. Some of you, I think, looked at that. And Teresa Shapiro, who is an attorney, an elder law attorney, and she touched on some of that. So the recordings of the seminars, generally, are on our website, Seniors Living Smarter, under Education or Resources. Brielle, do you know where they are on the website?
Self off. Yes, they are. If you go to the website, there's a tab at the top that says Education. And then under there is the seminar library, and then it will take you through all of the previous videos since 2020.
So that's a resource that we touched on some of that. And you're always a different perspective, so you learn and gain different things. Other questions? You're letting our panel off too easy if you don't come up with other questions. Catherine, I knew you would come up with one. Wait, here comes the mic.
Thanks, Brielle. So I wanted to know if you could expound on lines of credit. You said that it can be set up for an income stream that will last your lifetime, and I wanted to know how that works.
Yeah, the question had to do with on the reverse mortgage, if it's set up as a line of credit that you can draw from. So
I'm just going to use the example of a house that's $500,000. You own it free and clear, and when you do the reverse mortgage, they're going to give you access to $200,000. You're going to have choices of how you take that funds. We're going to close the loan, and once you close the loan, if your personal situation changes, all you're going to do is contact the servicer and say, my spouse died, because let's say you did it and you left it in the line of credit, which is going to gain you that earnings credit equal to the rate on the loan. So let's say you leave it in the line of credit because you're leaving money on the table, per se, choosing another outside, and you don't need it. 2 years go down the road and you lose a spouse. All you're going to do is call that servicer and say, I lost $1,000 a month in income. I need to change how it's getting paid out. You still have that line of credit open for you. You maybe took out $50,000 for a car. You still have $150 there. You're going to contact the servicer and change the terms of how you are getting that money. And you're basically going to say, I want to get a lifetime benefit that will go. They use life expectancy. All of these are life expectancy. So somebody that's 62 versus 72 versus 82 versus 92, they're going to get more money because of your life expectancy. So you just tell them that I need a 10-year, I want to change my payment plan to the 10-year plan. They're going to look at what that $150,000 is, and they're going to tell you what they can give you as a life benefit that will that will be for your life, till the youngest borrower is in the 150 years old. Or if you want to, say I want to get 500 out, well, then they'll just send you a check for 500 till it runs out. Did that answer it?
I think so, but you said 150 years old.
Mike,
Well, and that's what I'm saying is I'm using the number of 150,000 left on the line of credit, but they pick, when I say 150 years old, I say that and I forget that the reason why Congress and why they did that is they're trying to tell America that it's your lifetime. You can stay in this home, and even if you, let's just say, and I'll tell you, there was a customer that a long time ago, she got a reverse mortgage so long ago, before some of these changes, and that's what the non-recourse benefit is even if you live to be 150 years old, you're going to be upside down in that house. But who cares, because your heirs and your estate's going to have no debt, and you've got that lifetime benefit as guaranteed in Section 255 of the Housing Act.
So for those of you who think, no, I misunderstood. Yes, she did say, based on the last one to reach 150 years.
I know, and
when you accomplish that, okay.
Yeah, yay!
Hopefully with a quality of life too. Okay, any more questions? I hope that helped, Catherine. Okay.
Let me say one more thing is, I am going to be at my office 2 weeks from today at 2 o'clock. There's a flyer back on my table. I'm not going to publicize it to the public. I'm not going to be out there for anything. If y'all want just an educational training or, I promise you, no sales, whatever, just an educational, I have blocked it off only for y'all. And if nobody shows up, fine, but if y'all do, just pick it up and register and let me know, and I'll be there to kind of go into the details of it from an educational standpoint. I'm just opening it up there if you want that information. If not, I'll just be there by myself. It's fine.
So a follow-up discussion about reverse mortgage. You're the special audience who's invited.
I'm not going to publicize it or nothing. I'm not going to be. I'll just be there, and if people are there, that's great. If not, fine. Because my mom had one and I didn't understand it, I just want people to understand it. I don't want anybody else to be in a situation where they don't understand what they've done or how to understand or any of that.
I want to also endorse what she said. She really, truly, I've worked with Lori a long time. She's talked to a lot of my clients. No business may come out of it, but she's been a tremendous resource. She's not going to be trying to sell you a reverse mortgage, believe me. And Will too, they're committed to you having the information. So that is a unique offer on her part. We appreciate that, Lori. So we'll make sure and put that in our follow-up, Brielle, about that 2 weeks. So that'd be on the
It's 29th, and I just picked a time. Now, just 2 weeks from today, and I'll be at my office. We'll be in a closed room, and just 2 o'clock, and just like I said, I'm not going to have anybody else that's not affiliated, and I just want to be there to educate. That's it. And again, I don't want to overstay.
No, that's great. Karen.
I have one final question. If you execute a reverse mortgage and live in your home and you set it up for a certain number of years you expect to live and get withdrawals periodically,
Hold the mic up.
then what happens if you change your mind and decide to go into assisted living and sell your home? What happens to the reverse mortgage amount?
It's like any other loan. What you're going to do is if you decide you're going to need to move and go into assisted living, you need to sell, move in with your kids, whatever, you decide you need to leave, first thing you're going to do is go find out what that house is worth. And then you're going to get your mortgage statement out and see what your mortgage balance is. And then you contact the servicer and you say, I'm going into assisted living. They're going to give you 6 months to sell your home with 3-month extensions. So they give you up to a year to sell the house. Now, they're going to monitor you a little bit because they want to make sure that, they've got an asset that's a home with a loan against it. So they don't want you to say it's $1 million home and you're going to list it for $2 million. It's within reason. But all you're going to do is just notify the servicer, I'm moving. And they're going to give you time to sell the house. And then when you sell the house, that money's yours. It's not the bank's, it's yours. And you just sell the house and pay the loan off.
Okay, we're going to take one last question.
I have a quick question for Will. Is it correct that an IRA is not going to be part of a trust?
An IRA is not going to be part of a trust.
That is an excellent question, and the answer is yes and no from a certain
Depends.
perspective. It depends. That's the nuanced answer. No, so generally speaking, an IRA will have, a list of beneficiaries that the assets go to at such time that you pass away. That could be your spouse, in which case your IRA just becomes their IRA, and there's no special rules for that. Or if it's your kids or grandkids or whatever, whoever, you could leave it to anybody, then that's what they call an inherited IRA. And they then inherit the IRA per the instructions in the contract of the IRA agreement. And then there are some rules as to how many years essentially the trustee of the IRA, which is your asset management company, they're usually considered a trustee, how many years they have to distribute the assets in full out to the beneficiaries. So that's one path. Also, you can make your trust the beneficiary of your IRA, or your estate the beneficiary of your IRA, in which case then those distributions will go to the corpus of your trust or your estate, and then they can be distributed out that way. So there's the yes and no answer to that one. Thanks.
But
Great
hopefully
question.
it gave you information, or go talk to Will some more, Carl. Okay. I want to thank our panelists today. I want to thank you for taking time to be with us and thinking through the information that people need. Remind you to not finish quite yet. You're going to turn in your feedback forms. If you're interested in the Downsizing Club or a consultation, mark that on there. And look forward to seeing you at our July seminar, back to the second Thursday, July 13th. I know a few of you said, I thought it was last week. Yes, we are usually the second week, but Vacation Bible School ran us out, so that was a worthwhile activity that we needed to change so they could have a very successful event here for the children. But the one in July, Embracing Technology for Your Health and Safety. And some of you are going, what does that mean? It means come, so you'll find out. I'm excited. We're going to have live demonstrations of some amazing technology. Now, we don't even have an Alexa, so we're way back here. But after a preview with our speaker next month, I think I'm going to have to cross over. There are so many things that could help keep us safe in our home. So we'll be talking about smart home technology, or our resource person will be, assistive and adaptive technology, touch briefly on wearable devices, and see some demonstrations of some of these, so it'll be a lot of fun. And look forward to seeing you. In the meantime, stay cool, good luck, and have a very special, happy July 4th. And feel free to call us or ask for a consultation. Thanks for coming.